Well, it looks like it's pretty undeniable at this point. A lot of the episodes we're going to be putting out going forward, until this thing changes or levels out, are going to be focused on coronavirus. And I think this is the prudent thing to do as someone who is creating content about investing in today's landscape. Obviously, as we mentioned during the recording, the landscape tends to change every 24 hours or 5 hours. So understand that if you're listening to this 6 months in the future, that things may have changed significantly since then. And we've already made some comments that, didn't age well in terms of how accurate we were trying to be. But the truth is we're just trying to put out the most accurate information that based on what we have available to us at the time. So today, we're going to talk about different asset classes and how the fear and as well as the actual pandemic or potential pandemic could impact the real estate business and different parts of the real estate business. We have a very sophisticated, very savvy passive investor with us today, and we're going to jump right into it. So, one of the things we're going to talk about, first of all, is how does this compare to other recessions? What does this feel like compared to 2001? What does this feel like compared to 2008? You probably saw the jobless claims number recently come out, 3.3 million, which is completely unprecedented. The peak of 2008 was less than 700,000. So this is a massive, massive shakeup or pause on the overall economy. Now, which asset classes are most well-positioned for this? That's something that we're going to figure out during this call. We'll speculate on, of course. And which asset classes are going to be exposed to this risk? There's a couple in here that we are very bullish on generally, but may have some risk specifically related to corona. And yes, it is true that blood is in the streets right now, but we don't know how deep the pit will go. So our guest is going to talk about when the right time might be to jump into some of these deals. And of course, we're going to talk about the potential for a 1-2 punch. I'm not going to go into the details. You may know where this is going. We'll talk about it in the episode. So from my perspective, it's basically 100% that we're going to have at least 1 quarter of negative economic growth. The question is, will we have 2? And I think that's very, very likely. I think the likelihood that we're going into a recession is very, very high. And if there's one thing I know, it's that the cure for a recession is a brand new iPhone 11 Pro. And you can win one. So all you have to do is go over to Instagram, follow me at HunterLThompson_, and you're entered to win. As soon as I get 1,000 followers over there, I'm going to give away a brand new iPhone 11. Hope you didn't take my joke too seriously. Sorry if I misled you on that one. Just kind of going along. So head over there, give me a follow, comment iPhone in the most recent post, and you'll be entered to win. I hope you enjoy this episode. You're really going to like it. A lot of details, a lot of great information. See you on the other side. How's it going, everyone? Our guest for today is Jeremy Roll, who is the president of the Roll Investment Group. He's also the co-founder of For Investors by Investors, which is a nonprofit organization which provides in-person networking events across multiple states all over the U.S. He is also a very experienced passive investor. He's invested in virtually every type commercial real estate transaction that exists, and he's actually the investor in more than 70 passive investments. So it's a real honor to have him on. Jeremy, thanks again for coming on.
Hunter, thanks for having me. I really appreciate it.
So we have so much to talk about. First of all, Jeremy has been on this program twice before. We'll link to those 2 previous appearances in the show notes page. But this appearance is going to be unlike any other because we're in the midst of a real serious lockdown because of the coronavirus. And the date right now is March 26, 2020. The reason I'm mentioning that is that every day there seems to be new updates, new news articles, new headlines coming out, and things change very quickly. So I just didn't want to give the impression that we're talking to you from the future or from the past because every single day different updates come out. So we want to be honest about the time so we can actually be transparent about what's going on from our perspective. So Jeremy, in the world of Jeremy Roll, what is going on? First of all, tell me your high-level overview of the crisis itself, and then we can start talking about real estate as well.
Absolutely. So, and again, thanks for having me on. I hope this podcast is helpful for everybody out there. I couldn't agree with you more. By the way, this is just changing by the day. And, normally I read about an hour or 2 or more of economic news every day to try and stay on top of the trends and stay ahead of the curve. This has just been, I can't even keep up with it just because I've been doing my normal economic reading. And then on top of it all, keeping on top of the coronavirus. So it's been very challenging. I've actually been tracking the virus since end of January, and I've literally been reading up on it for about an hour or 2 a day since then. And I was very worried by the beginning, and I kept telling everybody the exact same thing. I said, you just someone tell me mathematically how this isn't going to end up everywhere with the fact that we're traveling and the borders aren't closed. And they're like, unfortunately, that's exactly what happened. So it's been a long time since I've been tracking this. What I would say is that right now, it's fairly obvious we're in the middle of a very quickly increasing curve in the U.S. The data that is actually presented and the testing that's done in the U.S. is very skewed, very limited. I could tell you stories about people I know who's like should have been tested and weren't, who probably have it. So the picture you have in the U.S. is definitely muted compared to the reality out there. But, it's actually great that we're recording this today because we just got the first weekly jobs claims number like today, this morning, and it's literally off the chart, 3.3 million almost. And when I say off the chart, it literally defines off the chart. I think the previous highest number was about 682 or something in the previous recession. And it's close to between 600,000 and 700,000. And I think in at least one previous recession as well in the past. But I mean, just off the chart. And so this has been a huge shock. I think a lot of people are trying to sort out how long this is going to go on for, which I personally have some thoughts about we can get into, which is one of probably the most important things I've been focused on. And I personally, as a passive investor, embracing for less cash flow in the coming weeks, months, and possibly quarters. We'll see. While all the different operators are trying to sort out how to handle each of these properties and the different asset classes. So those are some of my very high level thoughts. We can get into a lot more detail, obviously.
Yeah, no, I appreciate that and agreed. I think that eventually the containment rate is going to come down significantly. Like I said, as the recording of this, we're in basically a full nationwide quarantine to a certain extent. I'm in California, Jeremy is as well. And I haven't driven in a car in quite some time, and I haven't really left my apartment in a couple of days. And it's not odd. It's not uncommon given what's going on right now. You can look outside and the streets are basically bare, only filled with people who are moving groceries to and from. So pretty absolutely remarkable. Let's talk about, and this is really the reason I wanted to have you on, is you're in a unique position to talk about several different asset classes because you're an investor across multiple sectors in the real estate market. What are your high-level overviews of each of the commercial real estate assets in particular that you're currently investing in? And give us a high-level summary of where you anticipate they're going in the future as well.
Yeah. So, in fact, I just saw a chart earlier today, Hunter, that I'll send to you later that showed to date for the publicly traded REITs, the real estate investment trusts, per asset class, how much have they gone down on average? And what was so interesting is that senior housing and assisted living was definitely by far number one. And that one is definitely being impacted on case-by-case basis, depending on the property. Some tenants are moving out because they're scared to stay at a facility, and some of them are moving out because other people have gotten into facilities. And so they're going through quite a chaotic time in the senior living space. I think long-term, senior living is a great bet and probably one of my 4 top asset classes for the next 10 years for just more predictable cash flow, which is what I look for. But right now, that's a very, very uncertain time for them. And then you have some obvious ones, like retail, office. Those are obviously down a lot. What's really interesting, and you're going to be surprised about this, Hunter, is that mobile home communities are actually down more than average within the REIT. And I think the only sense I can make of that, given the fact that, mobile home parks tend to do very well during downturns, relatively speaking, is that I think that because the cap rates have compressed so much in an asset class over the years and became so expensive, more so I think than any other, I think it had the most compression of any major asset class now, that it's kind of reverting to the mean and has a further way back to go, right? And that's what I was hoping for as an investor once we had the downturn and therefore breed more opportunity. And it seems to be playing out if you're looking at the pricing across mobile home parks. So I can tell you historically, mobile home parks, what happens in that asset class and down is that typically the occupancy rate tends to drop. Some people lose their job, they have to leave, but rents tend to hold firmly because they're the lowest price, residential main asset class. And also because they have a lot of demand. Supply and demand is out of balance in most parts of the U.S., very low supply of those parks in general. And so they can typically fill those vacant units relatively quickly. And so the rents tend to hold. And so it's interesting that, again, knowing that probably what's going on is there's a bit of a repricing based on cap rates adjusting, which is very interesting. And that's kind of now what I'm expecting may occur and was hoping for in the non-publicly traded market, like the non-institutional deals that we invest in. Self-storage which everybody talks about tends to do well during downturns. That's actually playing out as you would expect, in that it's actually the least affected asset class of all of them, all the major asset classes in publicly traded REITs right now, down the least. And to give you an idea, I believe that the self-storage asset class was down 16%, senior living was down 49%, and then everything's in between, right? Mobile home communities were down 28% from what I recall. So self-storage is doing very well, as you would expect. In fact, you and I, Hunter, are invested in a fund where the operator already mentioned that the demand has actually increased in the past week as people tend to lose their jobs and have to move maybe back home or double up with people. They tend to end up in less square footage and they have to store their stuff somewhere. And so I'm actually, again, that's one of my 4 top asset classes for the next 10 years in the right location based on an aging population that has to retire, probably the lower, southeast and some of the Sunbelt states, picking up a lot of people who are coming, downsizing in terms of their square footage for retirement, and going to therefore have to store things somewhere. And that's also playing out very well during this downturn, though. And if you look at the statistics in the last downturn, that I think the Self-Storage Association published that I think rents were down on maybe 5% overall. That's institutional data, but still good to know in the self-storage asset class. And that's reflecting again in the fact that the prices are holding better than any major publicly traded REITs. So, and medical office is holding very well as well, which is not surprising because that's kind of a continued need regardless of where we are in the economic cycle for the most part. So Hunter, I wasn't planning necessarily on referring to REIT pricing, but I think that really tells you what the market thinks right now about what's going to happen with a lot of those asset classes. So hopefully people are finding that helpful here.
Yeah, well, it's certainly helpful. I mean, one of the reasons it's really useful right now, especially, is that real estate tends to lag to a large degree. And in the sense that it's all good until someone has to pay rent. And so this was 2 weeks ago. For the last 2 weeks, most people haven't had to pay for something like multifamily apartments, for example. So over a week from now, things are going to change a lot as we start to feel those unemployment rates trickle down into people being unable to pay rent. If this does continue, it will be very pronounced. Now, I want to circle back with something you said about the mobile home park. Actually, it's interesting. I actually had that chart pulled up and was going to pull it out as a rabbit in my hat after you got done with your explanation, but it looks like you already have access to it as well, which is good. So yeah, the mobile home park business is interesting. It's an important thing to look at. I think that it's similar to cap rates across A, B, and C class multifamily apartments, where early in the cycle, you see C-class assets trading at 8% cap rates, B-class assets trading at 6.5% cap rates, A-class assets trading at 4% cap rates. And then towards the end of the cycle, everything is trading at a 4 cap. And so what happens is when there's a recession, the 4 caps stay 4 caps, basically. Like the Los Angeles, California 200-unit properties stay 4.5 caps, and everything else reverts back to the mean. And the swing can be very large because the variance is just there. Now, at the mobile home park, for example, you're looking at the value of a REIT. The value of a REIT is valuation. It's similar to the value of an asset, not the cash flow. So you could find a marketplace where 10 years ago, someone was only willing to pay 10 times your NOI to purchase an asset. Now, they may be interested in paying 20 times your NOI to purchase an asset. That would be a 5% cap rate versus a 10% cap rate. So what Jeremy's kind of communicating is that mobile home parks are in a position to swing back towards those previous valuations. It doesn't really speak to the NOI, though, which is how those more predictable returns are generated. So I just wanted to mention that. I think it's really important to differentiate that. It doesn't mean that rents are down 40%, for example.
Yeah, those are very good points, Hunter. One thing I want to add is that, because I think a lot of people out there who are listening probably also invest in apartments, and I probably should address that too. So apartments are right around the midpoint. They were down about 22%. And some people are probably thinking that's surprising because there's a lot of discussion in general in the investing world about how apartments are somewhat immune to a downturn because someone always has to have a place to live. But that's just not the way it works in a downturn. And so in a downturn, if you lose your job, you may need to go back home. You may need to go live with family. You may need to double up with somebody else. And we do see increased vacancy in apartments, and rents come down as a result because of supply and demand. So, no asset class is immune, that's for sure, but some tend to work better in recessions than others.
Yeah, I know, Jeremy, you and I have both been big proponents of multifamily apartments generally in terms of the thesis. I know that you had some challenges with the pricing, but just generally speaking, the thesis remains intact, self-storage, mobile home parks. You mentioned retail. that is something that's really challenged right now, the likes of which I don't think we have any historical data to really compare to. I mean, in a recession, you may see a 30% or even a 40% reduction in sales, but not a complete zero, goose egg. How do you anticipate this playing out in the world of retail in particular?
Yeah. So what's interesting about the stimulus that's already been provided, we're recording this on March 26th, is that there was specific targeting towards tenants to help them. And the fact that, I think there's a 60-day moratorium on evictions. I believe that the agency lenders for apartments are allowing a certain kind of deferral of payment to certain landlords, which I think they're allowed to then pay within 12 months. But that's under the requirement that no one can be evicted from that apartment building for 12 months, which is nuts, if I understand it correctly, because that causes other challenges. Retail and commercial office and industrial, and even a non-agency loans, none of that has been addressed yet. And so what's not really clear yet, it's a little early, is whether it will be addressed. Now, if it isn't, that's going to be a huge problem for retail investors. If it is, then hopefully there'll be similar programs that have been put in place to help kind of put a pause on either payments or allowing tenants to be able to pay more easily. There have been a little bit of programs for small businesses that are meant to kind of keep them going, but I think it's, a very small percentage of what's truly needed as far as the real total size of the pie. And the government hasn't yet addressed direct help for retail strip centers and some other more commercial type of opportunities. I think that if no help is to come, then it's a question of loans, right? So the biggest single expense most properties have is their debt. And, it goes without saying if a property doesn't have any debt on it, it could probably kind of manage through. But if there is debt and all of a sudden all their tenants stop paying, your revenue goes to zero and you've got a big expense, that just doesn't work. So what I'm thinking is that I'm wondering how the lenders are going to handle it. And each lender type is going to be either easier or more difficult to work with. So we're going to have to see how that all plays out. And as an investor, I'm kind of waiting to watch this happen and see what happens. Nobody knows yet for sure, because I hate using this word because it's just it's overly used. And I honestly don't believe in this downturn being different. But this seems unprecedented at this point as far as what people are trying to deal with. And I think the banks are going to have an unprecedented problem on their hands, depending on how they choose to handle it.
Yeah, I think unprecedented is certainly fair. I think with the really focusing on the freeze of an entire sector, which is, hotels, travel, luxury, anything, retail especially, it's going to be interesting. Now, I wanted to discuss the liquidity situation because what happened in 2008, which made 2008 the aberration, is that banks generally, they don't want to be in the business of owning real estate. What happened in 2008 was that renters couldn't pay rent, owners of property couldn't provide flexibility, the lenders couldn't provide flexibility, and were therefore willing to sell, to first foreclose, and then to sell assets for pennies on the dollar just to get any sort of liquidity into their balance sheet. That's kind of the death spiral that created 2008. Where do you see us on that spectrum, and how do you see us playing out when it comes to banks willing to foreclose? And there's so much liquidity in the market.
Yeah. So I think one very important thing to watch is whether the government relaxes the rules on mark-to-market, which they did do actually in the previous downturn, which allows it's very complicated, but depending on the type of loan and whether it's held on the books or not, you may have to mark-to-market the actual current value of the property, even if it's still being, if it's not being paid, for example. And if they can relax those rules so that the banks don't have to do that, they may be able to actually defer the payments, right? But if they have to actually show that impairment on their balance sheet right away, then they're going to have to foreclose and sell it off to actually get it off their balance sheet and get whatever they can for it. So there's actually a lot of different dominoes that could fall or may not fall depending on how the government chooses to handle it, and all different parts of the government have to make these decisions. So I think it's still a little early to be able to, I don't want to be a cop out as far as answering it, but honestly, I think it's too early to determine what's going to happen, because I am not convinced that the government's going to sit by and do nothing. And I'm not just saying that because I'm an investor. I'm just saying that because they've addressed almost every other thing they can except for this type of problem, right? They've addressed tenants and their challenges. They've addressed unemployment and their challenges. They've addressed small businesses to an extent and some of their challenges. They have not addressed this additional domino on the real estate side and how it's going to affect banks. So what I'm expecting, honestly, is that either there may be a future stimulus package that tries to address this. How effectively address it and how wide of a net it's going to be cast is yet to be seen. But I'm expecting that could occur. I think there's going to be a lot more pressure for that to occur once we come around to April 1st, see who does and doesn't pay their rent, and then start to have some of those larger institutional type of companies put pressure, and I'm talking about landlords and real estate owners, put pressure on the government to actually, and also they're going to put pressure on the government and they're going to put pressure on the banks, because they're going to start calling up either the banks or the lenders and say, look, this is what's happening. Can we negotiate something here? And the lenders are going to understand how big the problem is. I think that until it's a reality and nobody sees how big the problem is in terms of numbers, it's probably hard to ask for this stuff, even though you can somewhat see this coming down the pike. And I'm hoping that when that happens, we will get some help from the governments, the banks, et cetera. And if we don't, then it's going to be, then it's very obvious what happens, right? I mean, a lot of those properties are going to get foreclosed if there is no way to stop it otherwise.
What do you see as being the domino that will create that decision? Like, do you anticipate massive firms going under before something like that happens? Or do you anticipate them working on that currently and unrolling something, preliminarily before we start to see that spiral? And I know it's speculation.
No, I think, So I think what has to happen, and of course it's all speculation. I'm not a lobbyist. I'm not a politician. So this is all guessing. But, I think what has to happen is that April 1st has to come and go. The owners have to note down, okay, well, 85% of my retail tenants didn't pay me, and I'm this huge publicly traded REIT, and I'm about to go down. What am I going to do? I'm going to either try to negotiate with the lenders, or I'm going to call the government because I've been lobbying, and have lobbyists. And I'm going to make the government realize how big a problem it is with the real numbers. This isn't just like speculation at that point. That's actually real, right? I think April 1st has to come and go, and then we get a much better sense of the actual size of the problem and what the problem is. And I think then decisions can be made by the governments and the banks and the lenders as to how they want to handle it. But part of me wonders whether it wasn't included in this first stimulus package because it would have just been 3, 4, 5 trillion. And maybe they want to do it in tranches because it won't look as bad, right? Because they want to piecemeal it out politically. So I'm hopeful that something will happen. I'm hoping that something will happen. But realistically, it's very possible nothing will happen. The other reason why I'm hopeful is because there are a ton of, and I mean, again, I hate to say it like this, but the reality is that there's a lot of people in the House and the Senate and the government that owns a lot of real estate, right? Because a lot of them are very wealthy and they understand how this works. And so I'm guessing they're also going to be looking at their own backs, but we'll have to see.
April 1st is certainly an important date. I will say, though, that a lot of small businesses can and will float their business for a month or two while they see how this plays out prior to making a decision to close their doors and fire their employees. So you could certainly see a case where there's a retail center where it's been 2 weeks of pain. Then comes April 1st, they pay their employees get to pay rent. But by the time May 1st comes around, I feel like that's also a really, really important date if things are the way that they currently are. What are your thoughts on that?
I 100% agree. And I think May 1st will actually give us more information than April 1st, truly. I think that April 1st will allow some of these real estate owners to go and lobby for these changes. But I think May 1st is going to be even more critical for the exact same reason you said, even just for apartment buildings alone, for example, or any property where there's a renter paying rent that doesn't want to leave, right? They're going to do what they can to scrap it together.
Yes.
I do think there's been a lot of carnage already. If you look at the unemployment numbers, though, and I think that realistically, there's already going to be a lot of people who are going to stop paying. And each asset class is going to be different. I think some people are opportunistically going to stop paying too because they know they can probably negotiate. And so I think a lot is going to happen in April, but I think you're going to see the entire picture once we get through May 1st.
Okay. Let me ask you this. We are in the midst of a crisis. This is something that you've been both emotionally and financially preparing yourself for quite some time. We'll talk about what that means later in the conversation. But let me ask you first, is there anything that you could see right now that you would be very interested in investing in? And if so, what does that look like?
Okay. Do you mean investing in today or do you mean
like if you received an email today? Yeah, I mean truly today, like based on when people are going to hear this.
Yeah. So when people ask me what I'm doing today, the honest answer is that for the most part, waiting. And I'll tell you what I'm waiting for. There's 3 really key things I'm waiting for that I would encourage everybody to wait for if you're an investor, because real estate tends to move slowly, right? And if you look at historical cycles, it typically takes 1 or more commonly 2 years to really hit the bottom price. And so 3 things I need to wait for. 1 is vacancy discovery. 2 is rent price discovery. And 3 is market price discovery for an asset. And what I mean by those is that if I go and invest in something today and the net operating income is $1, right? The problem is that in a month or two, that net operating income may be 60 cents because there may be a lot more vacancy in the next month or two based on the April and May dates we talked about. And there may be even a reduced market price at that point, even if I find a new tenant or if I have to renew a tenant at that point, right? So the problem with me going at something today is that I have to wait to see where is vacancy going to go in that particular asset class in that location, and where is market rents going to go in that asset class in that location, assuming vacancies are going to rise and assuming market rents are going to go down. So by doing something today, I put myself at a huge disadvantage because I'm paying full price based on, or full NOI, call it, when there's probably going to be a reduced NOI very shortly in the coming months. Okay, and of course, I think the most important thing even is the actual market price for that asset class. And I think there's two reasons why we're going to have a hard time discovering that until at least early 2021. Number one is everything going on right now. And number two, which would have been happening anyway, is actually elections in the second half of the year, which even in a normal part of the cycle, without the rest of this, would actually cause a reduction historically in transaction volume as people wait to see who's elected and then what effect that could have on the economy and on real estate going forward, depending on which party was elected. So for me, unless there is a crazy compelling reason, I'm pretty much waiting. Now, that being said, what it would take for me to actually go into something today is at the very minimum 2021 or 2022 pricing. That's what I'm calling it. Meaning, if I can get the price that I will be paying in a year or two, which is presumably lower, and I think it's a very sustainable asset class that isn't going to have some major shock, then I'll take a look at it. But it's got to be, I would tell you that in general, it's got to be probably 150 basis point difference in the cap rate from where the real market rate was in the past 6 months, call it. And then I'll seriously consider it. Yeah. 200 basis points, even better. That's my own personal opinion. The 150 basis points is based on a typical previous downturns in terms of the adjustment in cap rate during those downturns on average. And so, if I can get the typical previous downturn adjustment in pricing right now, and I think that there won't be too much issue with the net operating income for that particular asset class, I'd seriously consider it.
I really appreciate you sharing that. I didn't know if we were going to get that level of detail out of you on that kind of thing, but that's actually very good to know. In fact, I wouldn't be surprised if that's possible in the senior living space right now. I haven't seen deals come across my desk right now because they are frozen. You can't conduct due diligence, meaning you can't go to a senior living facility unless you're essential to the business. But there certainly may be some serious pricing arbitrage available in that particular asset class.
Yes, I've actually already seen one deal that came to me in the past week that was a recap. In other words, some investors want to get out. Mm-hmm. And in fact, this has been going on for a while. So it wasn't new. It wasn't just they're scared they want to get out. This has been going on for a few months. But what the difference is today versus a few months ago is that the pricing has changed, right? So they're willing to recap at about, I would say, 150 basis points to 200 basis points, depending on exactly which comps you look at, difference. Now, the reason why I'm in no rush to do that is not only because they're in no rush to do that technically, is because senior living, one person gets the coronavirus in a facility right now and all hell can break loose, both in terms of losing that tenant, getting other people scared, and actually people proactively moving out of that facility because they're scared they're going to get it. And now all of a sudden you've gone from 100% occupancy to 60% occupancy or maybe even lower. And you're not going to find any tenant coming in the middle of all that. It's a very challenging time. Plus, depending on what happens with the loan, that could be even a worse situation, just compounding it. So my approach with that particular deal is pricing looks great, but what I can't sort out is the vacancy that we talked about, right? Mm-hmm. So I'm going to wait several months, see what happens with vacancy, see what happens if that particular facility gets the coronavirus. And then if and when we get to a point where, there's therapeutic antivirals that exist in a few months, I'll reconsider at that point. But even that really good deal, if you can't discover at the very least a vacancy situation, that's still a pretty big risk.
Yeah, absolutely. And that's one of the reasons why they're taking a hit in the private markets is not only the fact that the tenant base is more susceptible to this particular challenge, it's also the nature of the types of units lends itself to the contagion effect. Now, in all fairness, these properties are probably better positioned to eliminate contagion more than any other asset class, except for self-storage because people aren't there. But the tenant base is just at a high risk. The important thing about senior living, you can find high cap rates. The challenge, though, is that you also have almost proportionately large operating expense ratios. So in a typical multifamily apartment, you may have a 48% operating expense ratio, meaning that 48% of the income is going to pay off expenses. In senior living, the industry standard is like 70%. There's just so much labor. Now, again, that labor is a very significant line item, which allows you to create a vast discrepancy between a mom and pop owner and a best in class owner, because the people and the culture and the way that they're treated and that whole dynamic creates such a great opportunity in senior living. The challenge, though, and what Jeremy's alluding to, is that if you have a really rough flu season, I'm talking a normal rough flu season, and you have 100 units and 15 tenants pass away, you can be in a challenging situation in terms of debt service. So you always got to be cautious about all these things, particularly with this particular virus. And that's a really interesting comment because of that expense ratio thing. I want to talk about the thesis we've heard over and over again regarding C class, B minus class, everything, and how that relates to this particular risk. So I've been a huge proponent of it. There's a lot of data to back it up. Basically, if you're investing in C-class, anything, you're investing in mobile home parks, you're always going to have a tenant. Even if everyone moves down 60% in terms of their income, they still have a ton of demand in those particular sectors of real estate. How do you think the low-income earners are going to perform given what's going on with this virus?
It's a great question, and I think a lot of it has to do with the government stimulus that would just pass, providing people with checks and also pretty strong unemployment insurance. But the question is, okay, well, say somebody just got laid off and they're going to have 3 or 4 months, I think it was maybe 4 months of the kind of beefed up unemployment insurance. What happens after that, right? And I think the answer to that is there's probably going to be more stimulus to be able to extend it if need be. So I think that some of those people are going to be in a reasonably decent position. The problem is that will they actually be able to earn their entire salary from the past, and will they need that entire salary to be able to live where they are in terms of, what their expense ratio is for the actual living quarters, right? Which would be different depending on the market. So I think that, given what's happened here, and given if you look at like the service industry, which has been hit particularly hard, right? Waiters, all people in restaurants, all different services that have to close in retail, retail stores. So a lot of those tenants are comprised of those people, and a lot of those people lost their jobs. So I think there's been a disproportionate hit in the jobless to that particular type of tenant. And then it comes to the question, okay, well, if that tenant doesn't have a job, how are they going to be able to pay? And that's going to be up to the government at this point, right? So we'll have to wait and see whether that stimulus is, and I haven't actually run the numbers to see, okay, well, what is the current unemployment going to be if they're offering, I think it was up to $600 additional to each person each month? Are they going to get most of their salary, all of their salary, or not quite half their salary? I mean, that makes a huge difference, right? I don't need to tell you that unfortunately Americans tend to live paycheck to paycheck, and when their paycheck is cut in half on unemployment, they may not be able to pay the landlord. That's probably their single biggest expense. So time will tell to see how this plays out, but one thing is for sure, there's no doubt that they've been disproportionately hit, which also means that Class C apartments and even mobile home parks could be disproportionately hit this particular time around. I will say that, though, I still firmly believe that, and I'm invested in apartments and mobile home parks, but my personal opinion is that in the right locations on the mobile home park side, there's typically a waiting list of tenants trying to move in because supply is so much lower than demand in that asset class. It's so highly unusual that I think some of those parks will fare well, even if they have more vacancy than they would have had in a normal downturn.
Agreed. I was actually just on the phone with Josh Satin over at Gelt. Really smart guy. He's a listener to the show. I'm 100% confident he's going to listen to this interview because he's a fan of the show. He's a fan of yours. And we were just talking, both of us agreed that it felt like there's going to be some short-term pain in terms of the low-income C-class, B-minus classes in real estate. But there may be some more longer-term pain in the luxury and the A-class stuff. So you can see a situation where there's a month or even a quarter of some challenges, but again, that replacement factor where new tenants, maybe even better quality tenants, are moving into those properties and replacing other tenants. But if everyone moves down a rung, A-class may be really pushed over the next multiple years, and that can be affected not only in NOI, but also in cap rates. I don't think that's going to happen in C-class apartments. And the historical data is very compelling in terms of that short-term versus long-term. Something else is that we just did an episode that's going to be available at the time that this conversation is available about the 1-2 punch. It's very common in recessions and in life, in our own personal life, to get prepared for something, have it hit, and then you don't really see the second one coming, which is actually the one that hurts you, which is like a good example. That is like the NASDAQ bubble popping and then 9/11 happening, or, the housing bubble popping and then the global liquidity crisis happening. A lot of people have been talking about corporate debt. How do you think this plays a role in this conversation? Do you think that this could potentially be the challenge that pops the corporate debt bubble?
Yeah, great question. So there's no doubt that I have been waiting for that domino to fall. If you would ask me a year ago, what is going to be the final domino here that will cause a challenge in the stock market? Like, when is the true carnage going to hit the fan? It's going to be about re-rating of BBB corporate bonds that are probably not correctly rated before, let alone now, that essentially, once that domino falls, I think that this can get much worse. And in fact, if I had to guess as to what's going to be the next leg down the stock market, I'm guessing that's going to be that. And if you look at the spreads right now, they're actually pointing to that. They're already kind of in a danger zone, even after all the stimulus is taking place. So I do think that corporate debt's going to have some challenges here. And I think, the ratings agencies are funny because they never seem to be really reflecting the reality, right? There's been very few re-ratings thus far. I don't think there's anyone, disputing that when you have this record unemployment number, that companies are going to have major problems, and a lot of them were very highly leveraged. So why haven't they already been re-rated? And so I think it's just kind of a ticking time bomb. That's something to watch very carefully.
Because a lot of listeners are more focused on real estate, they may not know what that conversation implies. So when you say the danger zone, for example, what does it mean in terms of the metrics you're tracking to feel that way?
Yeah, there's a certain spread you can look at for corporate bonds to see like what are investors demanding compared to other types of other classes, more investment grade corporate bonds compared to junk, for example. There's a link that I have, and it's actually one of the Fed trackers that shows daily the change in the spread, or what the current spread is basically. And typically once that metric goes over 9 in terms of the basis points or 900 basis points, you're really in danger zone. We're actually currently at 11. And so that's what I'm following personally, that's showing the difference between junk and really high grade. And, what is the market demanding for that risk? And of course, you have to understand that the market demands a higher interest rate as they perceive more and more risk. That's actually what you're watching in that chart.
Awesome. And that's a really good metric to track for anyone that's interested in this space. You don't have to be an expert on corporate bonds. It can be very complicated. But the truth is, what this really refers to, this entire conversation about corporate debt, is that the leverage points are just exceptionally high. And so when you hear people talk about the corporate debt bubble, it seems a mathematical reality this will come to a crash at some point. And so a lot of people that have been speculating that this would be the next big thing because the leverage points are just simply unsustainable. Is that a fair summary, Jeremy, for someone that is not interested in being an expert, but interested in understanding the dynamic at stake?
I agree. Yeah. So what happened is that during this past cycle, to kind of make it simple, companies were using very cheap debt and it was available very easily. But because the interest rates were so low, they were levering up, buying back their own shares, and actually artificially increasing the price of their shares. And they were doing this with their earnings instead of reinvesting their earnings into research and development, for example, and other things that they normally would. And so what's happened now is that these companies have, higher than historical debt ratios. So think about when you own a property, if you're taking a loan to value of 90% instead of 60% on your property, that's very much increasing the risk. We're now getting to the point where the ratings agencies need to take a look at this and say, okay, well, this company was rated BBB, but they're not really rated BBB anymore because of this downturn and because of the fact that now they have a lot less capacity to pay their debt down. Just like a building would have a lot more distress if they have a 90% loan to value and the occupancy drops versus a 60% loan to value. It's the same idea.
Yeah. Okay. Awesome. So you're one of the few guys that's been investing prior to 2008. I want to hear your perspective on what this feels like compared to 2008. And obviously, massive opportunities were generated from the fallout of 2008. How do you anticipate playing in the sector once it becomes clear where the pricing does fall?
So this is completely different than 2008 for a couple of reasons. Number one is this is a health crisis that's causing the country to shut down and therefore being kind of a much more similar to a natural disaster, and it's a very large unforeseen shock. Whereas 2008, even though some people foresaw that this was coming, it was a financial crisis essentially, right? It was a lender challenge where people were lending money when they shouldn't have at certain ratios that they shouldn't have. And then that spiraled out of control once the entire, what's the best way to put this? Once the music stopped, right? And so that became a very, very concentrated on homeowners, and it became concentrated on banks. This is actually concentrated on literally everybody, right? It's concentrated on banks, concentrated on homeowners, it's concentrated on employees, it's concentrated on businesses. It's a one-time kind of just nuclear bomb on everything, right? Because the entire economy is practically stopping. So it's so different in many, many ways. And, I think that's also why when you look at the charts, the unemployment claims that we saw today are off the charts compared to 2008, because it's just having a much bigger effect on the overall population. Now, granted, I'm not trying to downplay someone who got foreclosed in the home that they owned for decades or whatnot. That's a very big life change and very bad experience, and very traumatic, obviously. But this is affecting, probably the majority of the population, literally, whereas, that affected theoretically a minority of the population, being the homeowners that got foreclosed.
Right. And it's just very pronounced, right? So it's basically, you're not getting a 20% reduction in your income. It's not that you need to find a new job. It's just that everything is completely paused. And it all started the exact same time. With 2008, it was like, oh, we can make it work. Other businesses are struggling. We're doing okay. Like, this is different at different times for different people. And it was just like instantly stop, no good.
Yeah. And there's one more thing I should add, though. On a more positive note, what happened in 2008, it took about 12 months roughly for the quantitative easing to really kick in, okay? And for it to be offered up to kick in from when the crisis started and was bubbling. This was literally, a couple of weeks until more quantitative easing starting by far than even last time. So the government response here, whether or not you like stimulus, government response, debt, whatever it is, no matter which way you look at it, the reaction has been crazy fast. And as a result, I believe that it's going to help mitigate some of the fact that this was a much bigger shock, right? So I think the response has been proportionally bigger and quicker compared to 2008 as well, which could affect how long this lasts and the magnitude of who feels it. I'm not saying that I believe that there was enough stimulus or not or whatever. I'm just pointing out that's one major difference as well.
Yeah, for sure. 2008 generated a lot of opportunities for you, for me, for a lot of people in the real estate sector. How eager are you to participate once the dust has settled?
I couldn't be more eager. And I say this because, and I don't mean anybody badly with a downturn, but I've been on the sidelines since the end of 2016, lobbying the operators I've invested with to sell. And I've been involved in over 30 sales, thankfully, since then. And unfortunately, not everybody sold. And now, so some stuff I'm just going to hopefully we'll make it through here. But the point is that I could not be more eager. I've been going through agonizing years of waiting, mostly on the sidelines, not fully, but mostly. And we're going to go from what I call, relatively quickly from like the worst time to invest in terms of peak pricing to the best time to invest in terms of the bottom in the next couple of years. So, the one thing I will say, though, is that I continue to have to be patient, because I firmly believe that, I'm writing off this year in terms of discovery of all those three things we talked about: vacancy, rent prices, and market prices. But the market price piece, we're going to discover more transactions. We're going to actually see what prices are adjusting to. But we're not necessarily going to hit the bottom. Like if I go invest in something in February or March of 2021, I'm not convinced it's the bottom. So I've got to do. Where it becomes a little bit more clear and a little easier to invest, I believe, is probably going to be 2022. We're going to have to be quite as concerned about catching a falling knife. And then further on, of course, if you're investing into an up market, that's always a great thing for most, if not all, opportunities. So, Hunter, I really could not be more, excited about what's going to be coming up. But there's a lot of challenges that are coming up before then as well. So we'll have to see how that handles itself.
Yeah, absolutely. I know we're short on time, so we got to wrap it up. But Jeremy, this has been really, really helpful. You've been obviously very, very much waiting on the sidelines, sometimes patiently, sometimes not so patiently, maybe behind closed doors. But I do appreciate you coming on the show. Before we jump off, I know you use LinkedIn a lot. Let the listeners know how they can connect with you on there and any other resources you want to give them.
Yeah, sure. I'm happy to connect with people, anyone. Any way I can help is great. If you're a new investor experience, you want to network, or if you have questions, you're new, because I've got like 18 years of passive cash flow experience investing. Feel free to contact me. If you're a sponsor, I'm always looking for opportunities. If you're another investor group, I'm happy to network. So best way to reach me is my email. It's jroll, JROLL, at rollinvestments.com, which is ROLL investments with an S.com. So again, jroll at rollinvestments.com. And to Hunter's point, you can look me up on LinkedIn if you want to learn more about me. I definitely have a profile that's pretty detailed.
Awesome. We'll link to those two in the show notes page. Jeremy, thanks so much for joining us.
Yeah, Hunter, thank you so much for having me. I hope this is helpful for your listeners, and a lot's going to change in the next few weeks. So hopefully for real estate investors, we'll get a little bit more positive news as far as government support, bank support, et cetera. We're going to see. It's going to be an interesting April and May, that's for sure.
Well, Jeremy, let's have you back on the show in 6 months, 8 months, and talk about what's taken place since then.
I would love anytime. You know that I'm happy to come back anytime. Thanks again for having me.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.